first off, thank you very much to Dr. Paul Talon for sharing this information with me, and I hope that this will be helpful to the students as they go through their assignment. So now, your first step is going to be to open up Google Finance, which I have opened up here on my Google Chrome browser, and select a key stock of a specific organization that you'd be interested in studying. So for me, I've decided to look at IBM as my primary example. And what you can see here is its current trading stock information as well as how it's been performing over the last couple of days. Now, what we want to focus on is capturing a historical account of the stock price of IBM. And so what we want to do is click on historical prices, and the next screen that will pop up is essentially a one-year listing of the stock price for IBM. Now, we want to take this information and export it out to Microsoft Excel. The simple way to do this is to come over and click on Download to Spreadsheet, which will download the file called Data CSV, where we can show it. Open up this file folder, and what we now have, if we just double click on the column line here, it'll expand out. We now have the current date for the opening, high during the day, low during the day, and closing of this IBM stock price, as well as the volume of the shares that were traded on that day. So the first step we're going to do is just clean this up for the eyes and turn this into a currency variable. So we highlight the variables that are dealing with dollar values, right click and click on Format Cells, and go over to currency and leave it at the 2 decimal points. We also want to turn volume, since we're talking about large numbers here. We're going to highlight these here, right click, go to Format, and make sure that these are listed as numbers without any decimal points, and let's throw some commas in there. All right, so we can see that on October 12th of 2011, the opening price for IBM was $186.08. It reached a high of $188 during the day, a low of $185.65, and it closed at $186.12. Now the volume was 5,338,149 shares of stock were traded on this day. So now that we have this key information, the next step is going to be involving your predictor variables. Now, for the purposes of this assignment, I'm going to just stick with some very basic information, and that your assignment will be expected to go further beyond this, but the purpose of this video is to just demonstrate to you the key steps that you need to do in order to complete the assignment. So we're going to go back to the Google Finance page, and instead of doing IBM, we're going to take IBM's competitor, HP, and determine whether or not their stock price actually impacts IBM's stock price. And so we're going to go back to that historical prices, and we're going to download an additional copy of the data information for HP now. And so what you should see here now is the dates and information. And what we're going to focus on here is we're going to take these back 2 columns, how HP closed as well as its overarching volume for the day. So we're going to highlight and copy both of those columns, and we're going to come over and paste them into the larger IBM data set. Now we're going to rename these columns so that way they're easier to recognize. And so we're going to take HP volume and HP close. And now to fix the formatting one more time, we highlight the whole column, right click, go to Format, click on Currency, and for volume we highlight, right click, Format, click on Number, and drop the decimal places and add the commas for separators. Okay, as you can see here now, HP trades at a much lower value than IBM, but it also trades much more extensively than IBM. So now that we have a basic elements to conduct 2 predictors, the HP's closing price as well as its volume on the IBM's opening prices, we're going to see whether or not there's actually any statistical relationship. Now, in order to do that, we need to first add in the tool pack. Now, to do this, if you don't have it automatically installed, which you'll know is if you click on the Data tab and you do not see Data Analysis as an option, you can click on File in Microsoft Excel 2010, go down to Options, click on Add-ins, and then go down to Manage Go, and you want to check the box for Analysis Tool Pack. Once you've done this, you'll see Analysis has now been added in. So the next step that we're going to do is click on Data Analysis, and for the purposes of our class, we're going to stick with a very simple regression analysis. All right, And now for the input Y range, this is essentially our dependent variable. And for us, we're trying to predict IBM's stock price. So our IBM field, the opening price of IBM stock, will go into the Y range here. Now to do this, we can enter this information in manually, or we can click on the little icon and click and drag all the way down for IBM's prices. Okay, once we've done that, we now want to go after the actual independent variables. These are the factors that we believe influence IBM's stock price. So the first step we're going to do is we're saying that HP's closing price as well as its volume affect the opening price of IBM stock. And so we're going to click and highlight all of these and drag all the way down. And once we're done, we now have the dependent variable as well as the two independent variables located in the G and H columns. Now, the next step we want to do is make sure that we output information out onto its own separate worksheet, and we want to also capture the residuals to help us with our prediction analysis. So once we have all of this information, we're going to click OK. Now, one of the other steps that I like to do is just kind of clean up the columns by double-clicking on the little lines. This will help us see all the information, and then we're going to format a few more of the tables. One of the other things that I like to do is name the tabs, so that way we have a proper amount of just easy to follow information. So the first step that we want to do is we want to clean up a little bit of this information. So first off, we want to clean up the coefficients. And for this instance, we're going to treat them like numbers, and we're going to have 3 decimal points, as well as the p-values. These are the values that help us determine whether or not something is in fact significant. So as you can see here, we have 2 variables. This was the HP closing price, and this was the HP volume, so the number of stocks traded on that particular day. And what we can see here is through the p-value, which we want to look for a number at a minimum of 0.05 or below. 0.1 can occasionally be used, but it has a much lower considered statistical significance. And so if we wanted to, we would have it just as a kind of a last resort measure. And what we know for sure, though, is that the HP close price, as we can see here, has an actual statistical significant relationship with IBM's opening price. In fact, IBM's price is negatively impacted by HP's closing price when it goes up. We also have here, essentially, as I said before, with the 0.1 value, that we can take and see that it's a 0.1 value statistical significance, but the impact is really nothing. So we can ignore this variable, okay? Now, the other step that we'll want to take a look at is the R-square and the adjusted R-square variables. Now, what we want to do here is format these into percentages, so that way we can get a general sense of the explained variance. So essentially, how much do our independent variables explain the dependent variable? And in this instance, HP's closing price as well as the HP volume combined explain roughly 29.93% of IBM stock prices, or at least its behavior. The next step we also want to take a look at is down here in the residual output. And this is essentially a prediction of how we believe IBM's stock price would do over the course of a period of time. And this is a currency variable. And so we now have the overarching value of IBM's prices. And so the next step we're going to do is try and build out an actual decision support system. And we're going to essentially first off start with a buffering percent of roughly 5%. So we're going to say that given the fact that we're making a little bit of a prediction algorithm, we want to make sure that we allow a little bit of adjustment, a little bit of variation to our numbers. So the first step, we're going to only do this for 15 days. So we're going to do day and 2, 3, 4, 5. And what you can do is once you've set up a pattern, you can highlight these and click and drag the box down until we have 15 days. We also want to have the predicted price. So that would be the information from here under the residual output. So we want to copy and paste this information in. And we also have the actual price. And so what we want to do here is go back to our data information, scroll all the way back up to the top, and find the opening price for the first 15 days, or essentially our last 15 days in our analysis. and pull in this information. Now we want to make our recommendations. Should we buy, sell, or hold our stock based on a percentage buffer of 5%, based on where our predicted value is and the actual prices are? And to do this, we're going to use a commonly used formula called the if statement. In fact, we're going to make it a little bit more complicated by creating a nested if statement. So the first thing is we do equals, which essentially lets Excel know that we're going to be inputting in a formula, and do if with a parentheses to enter the test. And now you'll see that it starts with the logical tests. So essentially, what is it that you want to compare, and then if it is true, what is the value that would be considered to be true, and then if it's false, what would be the value that would be considered false. So in this instance, we're comparing the actual price against the predicted price. And so what we want to do is compare actual and suggest that first, if the actual is in fact greater than the predicted times that little extra buffer that we're adding, then what we really want to do is indicate a sell recommendation. However, if it's a false statement, we want to create a new if statement to determine whether or not we should buy or hold. And in this instance, we want to take again the actual price, but this time instead of it being greater than the predicted price, we want to have it less, meaning we can get a potentially better deal. And take it by the predicted, and this time multiply it by 1 minus the buffer. And what this will give us is a buy recommendation. And if all else fails, we want to hold. And then see now we have one parenthesis that closes off the first if statement. And now we need to add the second parenthesis in order to combine the whole equation into one location. And once we hit enter, we'll now have a particular recommendation. In fact, what we're going to do here is center this. And once we have this recommendation, we can click on this drop-down box here, this little box, and carry it all the way down to give us essentially an overarching recommendation on what we should do with IBM stock. Now, the next step that we also want to add is a count feature to let us know the overarching percentages. And so we know that we have 3 options: buy, sell, or hold. And we know that we have 15 observations. So the first step that we want to do is do a new equation called count if, and we select the range that we're looking for, and then we select the criteria that we're looking to identify, and it will automatically count how many buys there are. Now in this scenario, there is none. So now we want to do this again for the sell, and you'll see now we have 4 sell recommendations, and we have 11 hold recommendations. Now we can also take a percentage number against our combined totals to give us an overarching number. And what we want to do here is now format this into a percentage value. So we can see that 26.7% of the time is the recommendation to sell IBM stock, while 73.3% of the time is to hold. Now logically this does make a lot of sense for IBM, which is considered to be a rather robust stock in terms of being a long-term investment. It's a blue chip type of a company, and so this would make sense logically for an IBM profile. So 73% of the time we'd like to hold. So now, seeing this information, you can continue on with the rest of the assignment in terms of data manipulation if you want to see, for instance, the visual information to graph it, which is something I'm going to leave out. That's something that you'll need to identify, but I'm hoping you'll be able to at least complete the major portions of building a decision support systems with Microsoft Excel. Have a nice day.